Another quarter, another loss for Tilray shareholders, who are left wondering why they invested in the company in the first place. Investors on Friday saw the equity sink as much as 15% after the release of the firm's second quarter financial results, which were highlighted by single-digit revenue growth that was offset by double-digit increases in net losses on a quarter-over-quarter basis. The cannabis turned distribution turned alcohol brewer seems to be further away from profitability than ever, while attempting to woo investors by boasting about net revenue growth. Guys, we're talking earnings, we're talking Tilray, let's dive in. All right, let's start off with the high level. Tilray Brands in the second quarter posted net revenue of $211 million, which represents a 9% improvement on a year-over-year basis from $194 million in the second quarter of fiscal 2024. The big story here for Tilray is that gross profits are in fact improving. The company posted 29% growth here on a year-over-year basis, with gross profit amounting to $61 million versus $47 million in the same quarter last year. Gross margins improved from 24% to 29%, which is a strong improvement. The problem here is that, well, they're still losing money hand over fist. Operating expenses in the second quarter amounted to $103.4 million, meaning they're spending dramatically more than they're making. The bulk of these expenses are attributed to general and administrative expenses at $46 million. While selling expenses totaled $16 million and marketing and promotion totaled $9.7. Tilray also had restructuring costs of $6.9 million during the quarter. This category also includes amortization expenses, which although non-cash totals $22.9 million. Things got no better after this, with the company recording an interest expense of $7.8 million and non-operating expenses of $33.3 million, which led to a net loss of $85.3 million. Versus $46.2 million in Q2 of 2024. On an adjusted basis, net loss totaled $2 million versus an adjusted net loss of $3 million last year. Adjusted EBITDA, meanwhile, was $9 million compared to $10 million in the same period last year. Tilray finished the quarter with cash and cash equivalents of $189.7 million, which is down from $205 million as of the end of the first quarter. Lastly, Tilray reaffirmed their 2025 revenue guidance, which is calling for revenue between $950 million and $1 billion this year. Let's get into the segments a bit here. As we mentioned previously, the company has several operating segments as a result of a business strategy enacted initially under Aphria before their merger with Tilray, where the company acquired revenue through any means possible, which basically means that the company transitioned from a cannabis operator to a distributor to an alcohol brewer, with a wellness segment thrown in there as well somewhere along the way. The largest segment for Tilray remains their distribution segment, which recorded $67.6 million in net revenue during the quarter and accounts for 32% of all revenue. Unfortunately for shareholders, this is a low margin business, with gross margins of just 12%, resulting in gross profit of $8.4 million. Next up is the cannabis segment, which accounts for $65.7 million in net revenue. Margins here during the second quarter came in at 35%, an improvement from 31% last year with gross profits of $23.2 million. The beverage segment is not far behind, with revenues of $63.1 million. This segment, however, is the most profitable for Tilray, with gross margins of 40%, an improvement from 34% last year, which generated $25.2 million in gross profits. Finally, wellness accounts for just 7% of all revenue, at $14.6 million, while gross margins totaled 31%, with gross profit coming in at $4.5 million. Tilray also indicated on Friday that they're having some problems with their current strategy. That strategy, referred to as Project 420, basically entailed the acquisition of a number of beverage alcohol brands beginning back in 2020 with the purchase of Sweetwater Brewing. The purchase was followed by the acquisition of a further 6 beverage alcohol names over the last 3 years, with that strategy also having the goal of securing $25 million in synergies by amalgamating all these different brands. In short, it's not working. Synergies to date have totaled $17 million, with Tilray directly stating that these savings are not completely offsetting their investment at the time. The company to date has identified redundancies in manufacturing and warehousing assets and has sourced cost savings through cutting costs in the areas of procurement, distribution, and back office costs. They've even worked on optimizing the brand portfolio in what they call SKU rationalization, which basically means they have cut products that weren't demonstrating their desired level of growth and have cut duplicative products. Basically, things were bad enough that they brought in consultants to help alleviate the issues, who came up with the idea of a regional jewel strategy where products are being cut from regions that are not considered key markets. The impact so far? Well, Tilray has said that they've lost out on about $6 million in net sales for the 6 months ended November 30th after focusing on certain products in key markets. And another $2 million was lost due to discontinuing certain SKUs altogether. Adjusted EBITDA has also been impacted to the tune of $1.8 million this quarter and $3.2 million year to date. Oh, and they expect a total of $20 million in lost sales for the full year as a result of those actions, which they're hoping will be offset by growth in new production innovation. But that growth is expected over the next 18 months, aka not really in this fiscal year. So how did investors respond? About as you'd expect. Over on the CEO.ca boards, Whale refers to the company as good for trading, not investing. Well, Gbove says he'll be leaving Tilray for greener pastures over at Aurora Cannabis. Expecting pushback from investors, CEO Irwin Simon, meanwhile, went on BNN Bloomberg on Friday to calm the markets, while working to blame the results partly on the Canadian government being the most profitable cannabis company. Maybe someone should tell Simon that cannabis isn't even his largest segment. Wolf of Oakville, however, seemed to have summed up the earnings nicely, with a simple GIF posted to Twitter with the caption, "What it's like to be a Tilray investor when they drop financials." Okay, so let's wrap it up. Is there a bright side here? Well, at least the CEO makes good money. As for investors, I mean, it's not a complete zero yet. But if you're still investing in the Canadian cannabis space in 2025, well, I suppose you aren't too concerned about returns anyways. Guys, if you ask me what's holding up this stock, I think that it is various investment advisors and portfolio managers who put their clients into it years ago that have not necessarily done their homework that are trying to hold it up. When I go on social media, I just don't see the retail following that I used to see years ago. And at this point, I can't really wrap my head around why anybody is purchasing any of these cannabis companies. Right now, I look at Tilray, I see an unfocused company that understands that they have a relatively cheap cost of capital that's trying to find a way to go out and buy revenue and buy EBITDA. But quite frankly, we don't really know what the ultimate plan is or how it's really going to spin out cash flow for shareholders in a meaningful enough way to want to invest your capital into this name. All right, everybody, thanks for watching. If you enjoyed this video, please let us know what you think in the comment section. Also, if you did enjoy it, please smash that like button, subscribe, and ring that notification bell. All right, everybody, thanks for watching.